going to get the a certain result at the end, right? But in trading, unfortunately, by the time you execute, price will change, and based on the probability, can go up, can go down, go sideways. So at the end of the day, it's a matter about how to handle your emotions, your psychology, and mastering risk and money management. All right, but at least for today, I'm going to go through in terms of whatever the agenda is going to be, and I'll give you guys more in detail what we're going to talk about. All right, as part of my disclaimer, I'm not here to give you any formal advice, but just give you excellent information that could increase your profitability or whatever you're currently trading at the moment in terms of your system, what you're currently using at the moment, but at least to give you the awareness, the mindfulness of price action, that when there's an opportunity, then basically take it, without hesitation. Any questions before I move on? Nothing? Okay, cool. And by the way, I'm not using GoToWebinar. I'm using GoToMeeting. So if you have a mic or you're over the phone and you want to, rather than typing, you want to say something, just let me know, and I'm going to mute you, okay? Or unmute you. All right, so what's the agenda today? I'm going to talk more of who I am for those who don't know me or haven't met me. I'm going to define mainly what technical analysis is all about, understanding more about candlesticks, totally different to probably what you've heard before. It'll be the same, but I'll just go a little bit more in detail. We're going to do some exercises just to show you about, in terms of price action, that once you see price moving, then you're either going to go long or you're going to go short. I'm going to show you a simple trading strategy, just a 2 or 3 step simple trading strategy that you can implement, that in addition to what currently you're already learning or you're using in terms of your system. And then we're going to do more exercises, give you more live cases and stuff. Okay, and then if you have any questions, a trade that you want me to look at, or what you want me to analyze and use the strategy that I'm going to show you, then feel free. So depending on how many exercises we're going to do, and depending on how many questions you might have, it may last about an hour, may last about an hour and a half, just to let you know. But at least I've given the time frame about about an hour and 30 minutes, but it might go lesser than that. So any questions so far in terms of the agenda? Okay, and lastly, I'm actually giving away $15,000 worth to actually lucky few. So I'm giving away $1,500 by the end of these. No strings attached. There's nothing. It's just simply, my goal is actually this month is a birthday present for 10 traders that I could help in order to be more of a consistent, profitable trader. Alrighty, let's move on. So who am I? I'm the founder and head educator of Enlightened Super Trader Education. That's been founded since 2003. Actually started in Australia, and then when I got married to an American and moved here to the US, and then going through more about the education industry, or knowing about the business here in the United States, got involved with a couple of trading companies, then basically left on my own because there's a couple of things that I didn't like with some educational centers out there. Obviously not all of them are like that, but I believe there's a certain element in order for a trader to be a consistent, profitable trader. Hence, created basically I call it the be to have trading principle. I personally believe that there is a certain element, a certain criteria in order to be a consistent, profitable trader, especially the psychology part. Okay. After researching and basically meeting thousands of traders, there's definitely a big deficit, because it's not like gaining a certification, law degree or a doctorate or being an engineer and so forth. The trading industry, the education industry is not regulated, unfortunately. So anyone can teach, and not all great teachers are great traders. Not all great traders are good teachers. So it's fairly a balance between teaching and trading. However, I also have a philosophy that, aside from sport and trading are the same, my philosophy is also trading comes first, teaching comes second. That's in my perspective. since I'm a full-time trader, since basically trading since 1998. I wrote a book called Why You Could Be Destined to Fail in Trading, How You Can Avoid It, actually getting great reviews currently on Amazon and Barnes & Noble. And in actual fact, at this point in time, I've never received a negative review, and it's a sweet little book, but there's a lot of exercises in the book. I basically being a peak performance trader coach, because not just basically as a coach in terms of sport in a high elite level, in a world class level, I use the same philosophy in the sports background, also in the way how I teach and mentor, coach traders. So I'm also a regular speaker, and also sometimes a consultant with some hedge funds and proprietorship trading companies, also article contributors. I contribute articles to like the Trading Pub or oh my God, there's a couple more to having mental blank. But nevertheless, you know, I'm always out there in the game, either speaking about the psychology of trading or teaching just simple trading strategies, mainly that would work in the currency market, since 90% of my trades are Forex and 10% are future index to hedge my position. Then I have a longer term trade in terms of stocks. So since 1998, basically I've traded everything from options, stocks, futures, and Forex. And I've seen, you know, the market crash in 2000 and also one in 2008. So pretty much I've been in the game, probably not as long as some other traders have been trading since the early 80s, but at least in terms of the experience, you know, from losing everything to gaining everything, you know, I've seen the ups and downs in terms of experience. All right, so that's based on who I am. Let's go through about technical analysis in terms to make it things objective. As a mentor and as a educator, as much as I can is to make things objective, including definitions. And the reason for it is because when it comes to technical analysis, it is always going to be very subjective, even if given to you a very objective trading methods. And the reason for it is because of perception. You know, we create our own personal beliefs or perception or whatever we believe in terms of the markets based on price. Now, but if we forget on what the market is actually telling us, if the market tells us to buy, we have to buy without hoping or, you know, believing on whatever you believe in. So if the market says to sell, you have to sell. If the market says to hold, then you have to hold. So it is the internal factors. There's a lot of variables that make the marketplace, right? So in order the price to go up or to go down. So to make things objective in terms of terminologies or what is technical analysis is simply the process of forecasting future price movements based on past and present price movements. The other summary of a technical analysis definition is simply the study of price, right? In my perspective, since regardless whether we're analyzing, we are forecasting price movements to dictate where price is going to be based on probability in the future, either to the upside, to the downside, or a sideways movement. And then we need to find enough evidence in order to execute or to execute to enter or execute to exit, to take profits or to cut your losses short or to let it ride, pretty much, right? Okay, moving on. To understand candlesticks, it's totally different to bar charts, to Ichimoku or open, high, low, close, but simply an open, high, low, close is just being dictated altogether and to create a normal candlestick. But since we're always looking at two-dimensional charts, we cannot see the third dimension when it comes to trading. Actually, I just came back from Chicago not long ago, about a few weeks ago, and just to see the VIX trading pit and the S&P pit, the options exchange, there's not much traders there any longer. It's not like 10 years ago where there's about 10,000 traders in one, and basically people are just nice and you know, they're almost like in a sardine type environment. Now there's an advantage on the other hand of being on the floor, being in the marketplace. It's like buying a property. You're in an auction and at least you can see who's buying, who's selling. And you can see through here, part of the trading floor, you see who's trying to bid, who's trying to say, hey, you want to buy this, you don't want to buy this stock, you want to buy this currency, you want to buy these futures, you want to buy this option. And then someone's going to basically dictate whether they're going to buy or not based on supply and demand. So unfortunately, the majority of traders will look into a candlestick chart and they only see the two-dimensional part of that. And hence, price patterns like morning stars, evening stars, bullish engulfing patterns, you'll see double tops, double bottoms, head and shoulders, and so forth. And then all of a sudden you say, well, it's a reversal pattern. But that's not true. It could reverse, but what if it is a breakout? But the most important part is the confirmation of what the market is going to really tell you, whether if it's really time to buy, really time to sell, based on what the market is telling you, to make it more objective, not subjective based on what you think and what you believe in. So in this particular case, if there's one supplier, there's a lot of buyers, there's a lot of demand, then it's just an automatic thing that price based on stock, based on futures, based on a currency, with the exception of options, and remember options are derivative, which is being calculated part of the price, and then you have your volatility and so forth, you have your gamma. So options, in my point of view, is a total different ball game. It's a different type of trading, right? Because everything is still based on the price of a stock or a future or of a currency. It is a derivative. So when price goes up and when there are more buyers than sellers, then automatically the price will go up. So price goes up when there is more demand, or there are more demand than actual supply itself. And the reasons for that, and where is the cause that it's coming from in terms of price to go up, is simply an emotional optimism. So once there's news, there's a rumor, there's insider information, there's greed, there's personal belief, and it creates the optimistic part where the people are like excited. This is where the price will go. Now they will try and bid for that price and order for the price, and the price automatically will keep on going. So the supplier, the seller will automatically say, hey, well, you want mine, then you want to buy it at this expensive price. It's actually kind of interesting. From moving to basically the Bay Area, when I bought a property here in Mountain View, before Google came in, and then we have the 2008, it was simply, you're like just buying cheap, wholesale prices based on properties. I was buying stocks at like $1.99. Actually, you can buy a good set stock less than $1 in 2008, in actual 2009, and then you can buy a property at a majorly on a low, like the wholesale price. And then when Google moved in, and out of nowhere, when neighbors started selling their properties within 1 week, in less than a week, price of, or the house actually been sold. And then they put in a bid, and then out of nowhere they will auction that bid. There's a price war, and there's like 100,000, 150,000 above the asking price, and it's like, holy moly! And what was the crash for 2008? It's only like 4 years, 5 years ago. So once there's a demand, there's a demand. Similar to Tesla is the same. A lot of news, a lot of in not just insider information, but a lot of hype, right? And then the price would go. And then Apple was the same. It went all the way to $700, pretty much a share. And then I said to one guy, I said, he asked me, what do you think of Apple? I said, well, I think Apple's gonna go drop all the way down to $400. And he started laughing at me. And I said, well, why are you going to buy at $700? Who gives you the right or told you that Apple can go beyond $700? Then out of nowhere he goes, well, news is saying, and if you look at the fundamentals based on the price to earnings ratio, I said, well, at one point in time, people will start selling, because if there is not enough demand for it, it's way too expensive, that will drop. Then out of nowhere, bam. He lost a lot of money. This guy lost a lot of money, and basically came up. He's like, I wish I should have listened to you. Well, the shoulds, the coulds, the woulds never happened. Gold was also the same. People were saying it's going to go more. And I said, well, good luck to you. There's no way. And I said, that price of gold can drop all the way down probably at $1,200 an ounce. Then, in my own opinion, I mean, gold can even drop all the way to $800 an ounce. So, it is simply just to fully understand behind the scenes of a candlestick bar or candlestick, well, not the pattern itself, but in order to notice the size of it, when there's more buyers, then automatically the probability of the price that is going to continue to go further the next day, the next hour, the next 4 hours, the next week, the next month is highly probable. Counter trending is good, but counter trending is also very dangerous if you're against price. In other words, you're against the flow of the current, or when there's a lot of momentum, a lot of flow, a lot of energy of a price heading to the upside. So those are the things that you just need to be aware of. This is the same that holds true. So here's pretty much an example that Wen's basically demonstrated a trade. Basically, it's a live trading, part of our live trading class. It depends sometimes. Like say, for example, tonight there's going to be some really good news out in Europe. So, I emailed the students that, hey, rather than us starting at 11 o'clock tonight, we're going to start at 11:45, just to prepare to get ready prior to a good major news at 11 Pacific Standard Time. So this happened basically not last week or the week before that, and through a bullish bar, when there's a really good bullish bar, there's going to be a continuation of that momentum somewhere sometime, depending on, well, this is pretty much a 1 minute chart. So it all depends. The market doesn't go in a straight line. They have to stabilize at one point, and then there's going to be a continuation of the price until it reaches a level of supply. So just basically showing you, demonstrating that based on a live trade scenario and a live case scenario, that once there is a good momentum based on the price for here, there's more, at this point in time, there's definitely more buyers than sellers. It reached a level of demand, and then currently part of that with the breakout of within the trend, and the momentum or the probability that it can continue to go to the next level is highly probable. All right, same holds true to the downside. When you see a red candlestick, a red open, high, low, close, I prefer as a trader is that if the opening and the closing is within the 1/3 of the range, meaning the range is the high and you have the low, that is the range, you divide it by 3, that if the opening and the closing is within that 1/3, that is a really good bearish bar or a good bullish bar. Meaning that you can really dictate, you can really see who's in control, whether the bulls are in control or the buyers or the bears are in control. So in this particular case, when there's a lot of suppliers, a lot of sellers, and there's not enough buyer, price will go down when there are more sellers than buyers. Price will goes down when there is more supply than demand. And the cause of that is the opposite of being optimistic, is mainly pessimism, based on news, based on rumors. Hence, sometimes based on news, good news, even if it's such good news, the price drops. Kind of interesting. Sometimes when the news are really bad, the price goes up. A great example, last month or we're already in August, September, July, FOMC meetings, Bernanke stated really good news, and what happened to the price? Basically, the markets dropped. Regardless if you're trading the futures index of the S&P or the Dow, man, it was tanking, right? Good news. But I believe everything always comes for a reason, where powerful people like Goldman Sachs, not just Goldman Sachs, but also institutional traders, where they have insider information. For sure, even before Bernanke is going to talk, they already know what the news is going to be. So when price gets way too inflated, hence the terminology bubble, right? It starts to get bigger, inflate, get bigger, and all of a sudden, bam, it pops. Even despite such good news, the price will drop because it's already been factored in based in the past, and who's been pushing all those prices is simply retail, like marketing type, CNBC, brokers. So they will try to sell and inflate those prices, whilst institutions or wholesalers have already purchased that price at a very cheap price. So at one point in time, when the price is already inflated, regardless of whatever the news is going to be, it is going to fail. If the market dictates it to fail, it will fail. So the question is then, when that happens, how can you then make money? Easy. You need to be with the markets. Hence, in terms of being objective, if the market tells you to sell, you got to sell. If the market tells you to buy, you got to buy. If the market tells you to get out, you have to get out. And the market will always give you clues, guaranteed, and I will actually show it to you on how. I can also give you a good, proper leading indicator that you'll be surprised. It's not based on your normal indicators like your stochastics, fast stochastic, RSI, momentum. Remember, all these indicators are still going to be lagging because all those indicators are calculated based on price. But it's already finished, it's already done. And some of the indicators are calculated based on the past 14 days, 15 days, 20 days. But if you use them, if you know how to use these indicators, then they will give you a little bit more of a boost in terms of your analysis. This is what creates the confidence when we're trading, because we need to have the confidence because we don't have the certainty, not like programming. The market is always dynamic, it is always uncertain. To reduce fear itself is by not just trusting and believing your trading system, but also giving you more confidence of whatever information that you might have outside from technical analysis, hence the macro fundamentals, which is actually very important. But nevertheless, the markets will give you clues even before it will happen. And these are basically used through multiple time frame analysis. If you know how to use that properly, then awesome. And then you basically follow that with the macro fundamentals, then man, the probability of you winning is highly probable. All right, moving on. Any questions in terms so far what I've shown you, where I'm giving you the third dimension, what's really happening, what causes the candlestick either to form a bearish bar like this or a bullish bar? So far, so good. Any questions? Nothing? Okay, we'll unmute everyone and just to give opportunity for you guys to say something. But if there's nothing, then I can move on, okay? Right?
You mentioned about some 50% loss on the candle divided by 3, high low divided by 3. Can you please repeat that?
Yes. So based on the range is simply the difference between the high and the low. So there's 3 things that you really need to fully understand. The high and the lows are institutionalized price points, not retailers. No way that we can dictate the price of the low or the high. It has to be an institution, whether it will be a bank, whether it will be a Goldman Sachs, market maker, or it could be a specialty. It could be anybody, right? But it has to be someone big, not you and I. The closing price is also going to be important. And the reason for it is because closing price is also being dictated by the professionals. When the stock market closes at 4:30, remember there's an open cry, right? The open cry. Have you guys been? Who's been to the trading floor at all, by any chance? Okay. If you haven't, well, there's a great documentary called The Pit or Floored. But nevertheless, just imagine this: you're the pit, like it's an octagonal type of trading pit. There's always going to be one person either in the middle or in the top right-hand corner or left-hand corner. That person is simply let the auctioneer, that auctioneer is what we call the specialist. That specialist is the one who is going to dictate what the open price is going to be. So the job of the specialist is to bring buyers and sellers to an agreement price. So say, for example, we have David on one side and we have Sharon on the other. If David is basically the seller and he knows or he knows that the price can go further, Sharon will be able to say, well, I want it at 50 cents, but David said, no way, because, this share is going to be worth $1.50 later on, so why would I sell it to you for 50? Either you come up to me or nothing at all, until another person will bid at $1 until the dollar will be met. So the specialist will then go say, hey, okay, I've matched somebody, or a buyer and a seller, bam, so that's the opening price. Closing price is also the same. The specialist is also going to average all the prices out to meet a certain price point, and then bingo. Market makers, the job of a market maker is simply to create a price of the bid and the ask. Hence, that's why market makers will always make money, and sometimes they arbitrage their trades, because regardless whether they sell or they buy, they will make money either way. So that's the job of a market maker. And institutions are market makers, right? So that's their job. The range, on the other hand, is the difference between the high and the low. Now, if you divide that by 3, so in thirds, 30%, if the opening price is within the 1/3 and the closing price is below the 1/3, then you have a good bearish bar. This holds true to the upside, that if the opening price is within the bottom 1/3 and the closing price is on the upper 1/3, then you have a good bullish bar. This means then that in this particular example, the bears are way too much in control. So in other words, the probability that the price can drop even further, especially when it's coming from a level of supply and dropping to a form of an equilibrium all the way to the demand, your probability of winning is highly probable, 90 to 99.999%. Okay, so your probability is still very high. However, once the price is getting to a demand, the probability of winning is still slightly higher, but there's a probability that the price will stabilize itself before either it will correct itself or continue the momentum of the price that already been dictated in the past. So just to demonstrate from this point is simply to give you that always remember and just be mindful that when you're trading, there's always going to be somebody behind that candlestick, not just a two-dimensional chart. And the one of the major issues of a rookie and intermediate trader is that once they see a price pattern, and I don't blame them, because that's what only they've learned from others who trade, say, reversal patterns or pattern traders, as I call them, is simply those patterns are not fully efficient enough unless you fully understand price, if that makes sense. So, I mean, no offense well to anybody in the room, but it's just simply from experience from what I have, because I also used to be a pattern trader, because that's what I learned. I used to be a systemized trader. I have part of the indicators. I have 3 or 4 different indicators, and then there's a price pattern, and bam, everything has to fall in line, without fully understanding what's really going through behind the scenes of that. And that's what I really wanted to know as a trader. I really wanted to master what is really happening behind the scenes. So all basically I've done is just looking, I see, yeah, there's floor traders, but how do they really operate? And I was talking to one guy, he used to trade for Goldman Sachs. And I said, what do you think is the difference between you as a floor trader compared to a retail trader out there? I said, well, simply put, it's supply and demand. They can't, retail traders have the two-dimensional chart. Do they work? Probably yes, if they know and they fully understand how charts work or technical analysis work. But if they using just price patterns with indicators, I said the chances of them winning is very, very slim. And the reason for it is because they are now buying at retail prices. Floor traders at least can buy at wholesale prices. As a trader, this is where I want to be. I want to be buying at wholesale prices, that if an institution is buying, I'm going to buy where institutional buyers are buying. If they're selling, I'm selling, not the other way around. You know, if you have a retail business, it is bad business to buy at retail and sell at retail. No go, no good, right? Yes, there are certain trading systems that are fantastic, buying at retail, but you're also getting just a small portion of selling at retail. Now, if you have a good abundance mentality, you're patient, you're disciplined, then it will definitely work. Guaranteed, and I know that for a fact, right? Now, but if the person is highly neurotic and pretty much being greedy, doesn't have the discipline, doesn't have the patience, the inconsistency will actually happen more than being consistent. Hence, 75% of traders will lose, but when I was at the floor, future traders, 98% of traders, of retail traders trade the futures market, lose. In a stock market, people who scalp, who momentum trade, 95% of traders, day traders, lose in the stock market. That's huge. Those are big numbers, right? In the currency world, on the other hand, part of my research is 75%, 76%, but those are the averages of people losing in the currency markets. However, I've seen, part of the research that I basically have seen, people trade less than 1 hour. The consistency or the probability the person will lose is highly probable. But if the person starts to use 1 hour, 4 hours daily charts and above, not just in the forex world, the futures and the stock market world, this is where they make more money, right? In terms consistently. Okay, yes, because we can't win all the time, but if we can be consistent, this is where we can make money, right? We can be profitable. In actual fact, there's an article which I should have at least put in here last week, stating that Goldman Sachs lost 7 days in a row. I don't believe that, right? Like in the bullish market, there's no way, right? But similar to what they dictated in 2009, when the markets crashed and out of nowhere, second quarter came along. They made something ridiculous. I don't know, like how many billions of dollars. So, they have their own agenda. It would be foolish for us to know that, just believe in what the media web bases say. But, big institutions, they have their own agenda. So to answer your question, Manny, yes, it needs to be within those 1/3. Okay, it's so important. All right, so part of an example. Same thing. So if you can see through here, when the price starts to stabilize to a certain level of supply, and then you will see price. And in this particular case, see how the opening and the close is within those 1/3. Bam! And out of nowhere, there was a big gap, and hence basically close the position. So they are very powerful because they give you the highest probable or the highest probability. Obviously, as a trader, you really also need to know within the trend, then because the market can only give you a certain portion. That if you are going, like I said, or counter trending, the market can only give you to a certain point, to a certain degree. But once emotions like hope, the shoulds, the coulds, the woulds happen in place because you want more, then it's going to be more of a dangerous thing, right? Alrighty, okay, moving on. The next one is that you need to understand is dojis and spinning tops. Institutional traders don't just trade pretty much in a day. If there's nothing, they don't trade. If there's no volatility, they don't trade. And I've seen people at the floor, they're basically playing Tetris. They're watching TV, watching YouTube. And in this particular example, you can see they're watching Bernanke. So if you've noticed in the markets, if you're currently a full-time trader or you're trading prior to your news, the spread basically increases. There's no volatility. And the reason is this is what's happening behind the scenes. They're waiting for a proper confirmation. With the exception of the few, the floor traders, because they can see emotions, they can see who's the big boys, they can see proper order flow. Now, even with trading stocks, if you have a level 2 based on an ECN, you still cannot see proper order flow. When I meant by proper order flow is simply who is really on the other end. Yes, you can see order flow, but you really can't see who is on behind the scenes who's buying and selling. Now at the floor, at least you will know part of their jackets. Do you see with their jackets? Their jackets just defines of which company that they're working for. So at least they can see who's there, and they can see whether they're creating some form of strategy. And then part of the inside of the floor is that there's going to be always insider information. If you put on Google, man, on a day-to-day basis, there's always insider information. There's always someone is always being sued by the SEC. Now, when there is going to be a lot of uncertainty, price is simply just trying to stabilize. Especially if there is a big bullish bar, then you see a doji, they're just trying to stabilize. They're trying to dictate whether if the market has more room in order for it to go to the upside, or maybe perhaps there's going to be some form of an important news. Maybe ECB is going to about to happen, or Bernanke is going to talk, right? GDP, PPI, CPI, all this type of stuff. And then based on the economy, based on inflation, based on the dollar index, so all this type of stuff based on the macro fundamentals. Traders are also looking based on that, based on the news. That's why as a day trader, or if you're a day trader or you're a scalper or a momentum trader, news is going to be very important because that's what dictates volatility as well. That's what creates liquidity between a buyer and a seller. Market participants are waiting for news to get certainty in the markets all the time. So now in the stock market, there's 4 to 6 reversals pretty much in one day, and those mainly reversals, if you really actually follow it, those are times of where news is about to happen. Now, as a currency trader, in most cases, in actual fact, not most cases, 90% of the time, starting from 4:30 Eastern Standard Time, part of Europe, then you have from 2 a.m. actual fact, sometimes 2 a.m., 3 o'clock, 4 a.m., either the ECB or the Euro, the German market will have a lot of news within that area. Then 5-ish will occur within the futures market, and 8:30, and this will either happen part of your CPI, PPI. Then 10:30, either a Fed person will talk, or 2 o'clock. So, and then 2 o'clock to 3, then 3 o'clock the bond market will close. So there's certain times that the market will have those news, and they have a certain agenda on why those times are being dictated, part of that. So now imagine a rookie or intermediate trader starts to day trade, and they don't have that type of information and knowing in terms of the times of those news. Man, they're going to get killed. They're going to get slaughtered. So to know the times of where you're supposed to be trading as a day trader is also important, not just in stocks, but also in futures and also in the currency markets, right? Very, very important. So those are the things, 3 things that you need to be aware. Bullish bar, bearish bar, and a doji. Dojis, spinning tops, I actually love them. And the reason for it is because that is the start when a pivoting point will occur. So I'm going to give it to you as a tip. A leading indicator, this is my leading indicator, is simply your pivots. And like I said earlier, the lows and the highs are institutional price points, not retailers. That when a low has rejected basically the previous low, so I say that low, so we have a lower low and we have a higher low. Once I see a new pivotal point, and I know I see, it doesn't matter if it's a doji, the probability of the bulls winning in an uptrend is highly probable, because to define objectively what an uptrend is simply dictating a series of higher highs and higher lows. But those higher highs, higher lows will also be dictated part of your pivots, because inside a trend, in order for a trend to form, you need 3 highs, a higher high and a lower high, To create a higher low, you also need 3 points, a lower low and a higher low. So that from there to there, that is simply dictating your higher high, higher low, and the next part of the series is simply a higher high. One guy emailed me and said, and asked, he said, hey, would you mind if I put your videos into my YouTube for my readers? And it's from my IBD. Because if you currently been watching my videos, 90%, almost 100% of the way how I analyze is right on the money, right? And the reason why I would be able to dictate what the next price point is going to be or the probability of where it's going to be is because of those pivot points. So I'm giving you a good tip right there. That is my leading indicator, because the markets, they are giving you clues, and those clues are being dictated through those pivots. So trends for me is so powerful, and when a trend is also within the alignment in the level of demand, you just got to buy whether it's a bearish bar or a doji, regardless, because they are giving you with the lowest risk with the highest probability of winning. And notice that I don't use any indicator. I have 3 different strategies, obviously, M1, M2, M3, and they have a purpose. Indicators like oscillators, they have their own purpose. Moving averages, they also have their own purpose. But please, 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 never ever trade and making your decision based on the indicator itself. You need to, indicators are just used to indicate, to confirm based on your analysis on price. Do you guys get that? That is technical analysis, okay? I know a good technician is when he or knows price itself. Sometimes people tend to say, well, I know price action, and then I test them. They don't know price action, okay? So very, very important. Okay, so let's move on to the next slide. Where am I? Sorry. I believe the next one is so what are you trying to speculate? You're trying to speculate by forecasting future price movement with the highest probability. Everything is about probability. This is one thing I love about trading the marketplace, is because I love numbers. Numbers, yes, there are no certainties in the marketplace, but if you have a high probability of winning, this is where you need to either enter with no hesitation. I have one client, actually, he's a very good card reader, like in terms of blackjack, right? He knows how to read cards. And so I basically told him, I said, well, it's funny you say that because the markets is also the same. So he told me that, I've heard it before, you have 0, plus or minus. That if it's on your above 0 and you're in a plus, you just have to, you have to bet. The higher the plus, the more money you can put in, part of your risk. If it's 0, it's neutral. Either you fold or you just put a little bit of money. But if you're negative, then definitely you got to fold. The markets is also the same. That if you are in a positive above 0, part of your analysis, you got to bet. You got to take a risk. The higher the probability, then part of your position sizing and part of your risk management, then you can put more. But if you're seeing, okay, the probability is a bit lesser, breaking even, you have a choice. Either just to put in to test the waters, put something small, and then if it's not within your own side, then you higher probability and you put more. But if the system, basically, if you have a trading system, and even though the system is saying to go in, but you don't feel good with it, technically speaking, if you really know your system, you would be able to measure the probability part of that. So if it's no good and it's part of the negative, you have a choice once again. Either you trade or don't trade, but I highly recommend do not trade. If it's on a negative, in terms of the probability, is very, very slim. Because if your probability is small and your risk is also high, then that's a bad trading system. A good trading system is with a high probability with a small risk. By the time the price gets to I call it a level based on basic economics or supply and demand when it reaches an equilibrium. Equilibrium is simply a 50-50 chance. 50-50 chances type are moving averages. Hence, that's why moving averages are actually on the last part of a trading system, regardless whether you use an 8, a 9, a 10, a 13, a 20, a 50, or a 200-day moving average. Exponential is actually even slower, but they are still, if you really look into it, the price will be at a level of equilibrium. So it's on a 50-50. So if you are counter trending on a 50-50, your probability is very slim, and then your risk is actually very high. Not a good plan. But if you are in a trending market and you are in equilibrium, then your probability is higher. The risk is also going to be high, but at least your probability of winning is also higher, right? So these are the things that it is important to know as a trader, whether you're a rookie or intermediate or an advanced. Alrighty. So here are the rules. We'll do an exercise. I'm going to show you some charts, and the rules are, it's simply, okay, next to you should have a piece of pen and a paper, that if it's a bullish bar, you simply just buy. If it's a bearish bar, you simply just sell. If it's a doji or a spinning top, you have a choice. Either you hold, or if you don't like it, you don't do anything. Does it make sense? Right? Do you guys any question in terms of the rules while doing this exercise? Right, okay, no worries. Okay, here we go. Just bear with me. I will put it a chart. Okay, just bear with me for 1 second. Let me move. It's beautiful. Use this. Alright, so we have this. So I just want you to focus on the current bar, okay? Just the current bar. Don't even bother looking at this for now. Okay, just to simply, it's a very simple set of rules that if it's bearish, you can see here it's the open and the close. They are within the 1/3 of the range. That if it's bearish, you sell. If you're bullish, you buy. And if it's a doji or a spinning top, either you hold or you do nothing. Alright, you guys ready? Okay, here we go. First candle. Are you gonna buy, sell, or do nothing? Right. Also, yeah, either you put it in there or write it down on your piece of paper. Okay, piece of paper. All right. I'll move on to the next one. So if you sold, congratulations. So there you see here, there's a big gap from the closing and the opening. We have a spinning top, and the reason why it's a spinning top is because the opening and the close is almost the same price, but you have a much wider upper shadow and lower shadow, and it's below the 1/3. Okay, you see, if I cut that into 3, the opening is below the 1/3. Likewise, for the closing is above the 1/3. Alrighty. So either you do nothing or you hold. Okay. Alrighty. Can I go to the next one? Bam. Alrighty, so we have another very nice bearish bar. You buy, sell, or hold or do nothing. But remember the rules that if it's a bearish bar, you sell, a bullish bar, you buy. Okay, next. Bam. In actual fact, this is where we're at today. So where do you think the price is going to be tomorrow? Right? So this is where this is where we're at the moment. So if you saw that you sold, then easy, you would have made money and you're 100%, right, in terms of winning. So at this point, I want you to write down what you think it's going to be based on what you see at the moment. If you did sell, then bingo, then that will, we'll see by the end. You will actually see by tomorrow, this is the euro against the dollar, whether it's a sell or a buy. Okay, I'll move on to a next one, right? Just give me 1 second. Okay, here's a new one. You can see here, I don't know whether if it's too small for you. Just let me maximize it a little bit. Still trying to maximize, just 1 minute. Okay, here we have the spot gold. At this point we have a spinning top, a doji. Also there's a spinning top, there is a spinning top, a doji. At this point we have a spinning top. So you're gonna sell, you're gonna, well, part of the rules is that if it's a doji or a spinning top, either you hold or do nothing, or yeah, that's all the basically 2 choices. Okay, all right, I'll go move to the next one. Bam. So we have a bearish bar. On the other hand, it's not as strong. It would have preferred good preference that if the close is within the bottom 1/3, then it will be more powerful. But nevertheless, just looking into this, the bears are still in control, whether we like it or not, right? So there's still a big drop. It's not as powerful compared to this, but still, if you're looking at the 3rd dimension part of it, the bears are still currently in control. You're pushing the price to the downside. So what will you do? Will you buy, sell, or do nothing? Okay. Awesome. So this is what creates the marketplace on what you guys are now dictating. Some will say do nothing, some will sell, some will yeah, basically do nothing or sell, right? Okay, bigger trend bearish. Okay, and then now man is trying to create, what's a bigger trend, blah blah blah, and without even looking at it. All I just want you to focus on is the current bar itself. Okay. All right, let's move on to the next one. Boom. Okay, now we have the bears at one point created the high, and then the bears took over. Okay, I'll give you another tip. Once price is actually dropping, and I actually love lower shadows and upper shadows. If you lower shadows, long lower shadows, and it's bears, I prefer with those shadows because at one point in time they have to close. I call them like pretty much a gap. In other words, they need to close from the closing and the low of the price. They have to test it. When there's upper shadows and there's a confirmation, at one point they need to feel the upper shadow somewhere sometime in the future. That's why I love long-legged Dojis. Okay, all right. Okay, let's go through. So if you said to yourself sell, then we'll see on the next one. Bingo. So currently, what are your thoughts at the moment from just doing this exercise? See how simple that is. I'm just letting you learn how to read price properly through letting your brain going through on the third dimension of really what's happening part of that. When you see this, yeah, bears are in control. What does it really mean when bears are in control? Price. So what does it mean when price is dropping? Bingo, there's more sellers than actual buyers itself. So when there's more sellers than buyers itself, then the probability of the price to continue to drop to the downside is highly probable. So what I'm trying to achieve with this workshop is just to let you be aware that if the market is actually telling you to sell, you got to sell. If the market is telling you to buy, you got to buy. If the market is telling you to hold, you got to hold. And, of course, for me, method one is the easiest and actually it's the most powerful system, but it also can be very complex. And the reason why it's a lot of complexity is one, yeah, you need to look at the trend, you need to multiple time frame, you need to look at the highs, you need to look at the lows, because these are the clues of what the market is dictating, was giving us, right? Okay, let's move on. With such a big drop within the momentum, so from the 1370 even all the way to 1270, that's 100-point drop in the gold market. So if you're trading futures, imagine the amount of money you've made in 2 days. Imagine the amount of money you've made even if you didn't do anything here but you sold over here, the amount of money you made in 1 day. 80 points or 80 bucks or 80 points in the gold market. I mean, calculate that. That's huge, right? Okay, here the bulls are currently in control. Of course, I'm just going to be focusing just the current bar. Why now do you think the price came back up a little bit? I mean, if you take some of your profits along the way, then there'll be an issue. But nevertheless, all right, here we go. We have now the bulls are currently back in control. You're gonna buy, you're gonna sell, you're gonna do nothing. All right, great. Let's go through. So if you bought, you would have made money the next day because there is the gap within their opening, and then later on basically drop. Okay, now we have a sell. So this point in time, you now have the sellers are currently in control. You're gonna buy, sell, or do nothing. We'll do one more. Bingo. So now you have sell. The sizes of the bars are currently decreasing a little bit, but sellers are still currently in control. We have a lower low, we have a lower high. You can sell or do nothing. Now simply, basically, the bears are still currently in control. Bam. Sellers are currently in control. If you sold from 1380, now you're in 1228. Okay. Sellers are in control. So there's only the 3 rules I've given you, right? If the bulls are currently, if it's a bullish bar, buy. If it's a bearish bar, sell. A doji, hold or do nothing. Sell. Okay. Buy, sell, or do nothing. Bingo. Awesome. All right, so at least now you know, just to demonstrate with such a simple strategy, you can make money with such a system. And to be honest with you, I mean, aside from the system that I do have, just looking at price itself, this is how I scale into my trades. Once you start scaling in and you know how to read price, this is where money will come into your bank account. Okay. All right. Any questions part of that before I move on to the next one? So this was just based on the daily chart. This type of trading will work in any time frame. Obviously, by the time you get to the 1-minute chart speed, things will change differently, right? Because you got to be quick. Now, if you go to 1 hour, then you're going within the 1 hour. So it's very clear, buy, and then do nothing, right? Then buy, hold, and then you can basically dictate, well, this is part of the next part now where I'm going to show you on how you can really basically part of your exit strategy. Like if you can enter, can you really hold? Because time or price, they go in hierarchy. The daily chart is simply, this daily chart has 24 1-hour charts. So as a swing trader and as a trend follower, this type of trading methodology is more of a trend following type of strategy. You can swing trade it part of the counter trend, but the real money lies is if you are within the trend, because you're letting it ride until it gets exhausted or the new change of trend will occur, right? So that's how it works. You have your Elliott wave theories. Elliott wave theory just been based on this type of trading strategy, and they created their own and based on science. I can go through it. It will take 2 to 3 days just to fully understand the mechanics out of it, but this is the basic stuff, right? In order to create a high probability, about 99% of winning, it takes 3 days just to tell you pretty much everything, and then you strip that apart and put everything back all together, because once information has been given to a human being in 3 days, you'll just go through the roof. It's just too much. But you have to strip it apart, master each part, and then you put it back all together until you fully grasp the whole concept. All right, now I'll just give you the basics, the basic rules. Okay, so in terms, I'll move on because actually already 4 o'clock. Can't believe it. All right, now that I've given you just a simple rule before, that if it's a bearish bar, you sell. It's a bullish bar, you sell. If it's a doji or a spinning top, basically you hold. And here's just a simple one. Step number 1 is you need to look at the current candle and identify who's in control. So in other words, if it's a bearish bar, then you need to identify that. Well, it's a bearish bar. Then why is it a bearish bar? Well, bearish bar means that there's more sellers than buyers. Why? Because the price dropped. So now if you imagine that behind the scenes, say, oh, okay, so there's definitely more sellers than buyers, then maybe perhaps there's some form of fear or pessimism in the markets. The market is telling me to drop, then hey, I got to drop. I got to go with the market. I cannot put my opinion with it. Step number 2, you need to look at the current candle. Is it a level of demand or supply? Demand or supply, to identify those price points of demand and supply is so important. Someone basically tells me, like, is that your support resistance? Yes, you need to know your proper definitions, like, to make it more objective. Demand is simply a price area or a price point where buyers are supporting price points, so supporting prices. Supply, or the area of supply, are price points or where sellers are resisting. And there's not enough demand, not enough buyers, and there are a lot of sellers at the top of the roof, and there's going to be some form of optimism or pessimism, and you can see that when it gets to the roof, isn't it interesting enough that in most cases a doji will form, or a hanging man, or a spinning top, if you know your stuff, and this is what creates the stabilization, the stability. Now, there's only 2 ways on what the market can do at a level of supply. Either there's going to be enough boost or push based on news to break that ceiling, to break those sellers, or to scare the sellers and may say, hey, I believe the price is going to continue to go to the upside, so hence when that happens, sellers are going to go, if that would be the case, then I will take my price or sell just a little bit and sell on to the next level of supply, because buyers are starting to come in. So when that occurs, and you will actually see it, that within the trend is an uptrend or downtrend, and actual fact, so being saying it's a bear flag. So you see these terminologies, bearish flag, bullish flag, they are all based on basic trading and knowing price on where they're supposed to be, because everything has a purpose, right? And people start making all the names and all of a sudden it became popular. So just imagine I taught you one strategy and you pass it on, like the Bible, they're giving you a Bible, it's for free, it's to spread the word, the same. So imagine there's an amount of people doing the same thing and following the same system, then all of a sudden, bingo, you have an airweight theory, you have a price pattern, you have a morning star, evening star, and so forth, right? But if you don't fully understand the basic mechanics on the root cause between buying and selling, then all those fancy stuff that you've been learning from an advanced person will be worthless, will be useless, right? So this is what's currently happening within the trading industry, where a beginner, a rookie, or an intermediate want to learn black belt stuff without actually learning the white belt stuff. Then all of a sudden they get introduced more and more information, and they get over information overload without knowing the basics. So that being said, step number 3, that if it's a level of demand, you need to buy. If it's a level of supply, you have to sell. Just imagine now you are within the trend of the demand or the supply. Your probability of winning is 99.9999999%. Totally guarantee you, and that's a big G word, right? Some people won't believe it, but that's just the way how it works. That's just the way how it works. All right, let's go through and move on to the next stuff. Here's now part of the next exercise. Same rules. If it's a bullish buy, you buy. If it's a bearish buy, you sell. If it's a doji or a spinning top, you either hold, do nothing. You can buy, you can sell as well. But you need to identify whether if it's a level demand or supply. And if you're good, you need to identify the trend. Okay? All right, here we go. Just bear with me 1 second. This time I'm going to put in a, since we got it with gold, I'm going to put in an index. And then on the next one, I'm going to add in I'm going to show you pretty much my stock chart, just to show you and prove it to you that this type of trading strategy will work in any type of trading environment. Okay. All right, I'm going to help you guys a little bit to make in order to make your decision. All right, so at this point in time, we have the bulls are currently in control, tested a level of supply, 15,517. If you look on the very bottom left-hand corner, notice that the high is 15,517.220. On this one, on the other hand, 15,521.49. 517,220, 521.49. So in other words, the high did beat the last high right there. I want you to also be aware about the closing price. There is a high and a low. The closing price, at one point there's a lot of buying pressure, touch the supply level, and then at the very end, sellers took over and took control and basically rejected and didn't want to go and close nice and high. So it closed halfway between the low and the high. So the question is, are you going to buy? Are you going to sell? You're not going to do anything. All right, so write it down on your journal next to you, so we'll see that as well. You can type it in there as well. Cool. All right, I'll move on to the next one. Okay. So we have sellers are in control. The closing price closed at the level of demand. We have a lower low, we have a lower high. Sellers push the price all the way down to 15229.53, close at 15302, which is the same time the highs of that. Right, so there is a demand at this point, however, create a lower low, broke out within the demand, and we are in an uptrend. Okay, part of the trending, still pretty much in the trending market. Okay, let me put in okay, I'm going to help you out a little bit too. That's the higher low. That's part of the pivot point. That's also the pivot point part of that. Create a new higher high. That was the last one. I just cut across. I just need to put into the last low right there. Okay, so you're going to buy, sell, or do nothing. Okay, Brian says to sell. Fu says do nothing. Okay, I'll move to the next one. Bing says sell. Alright, so we can see that level demand at around the 15.3 is really strong, but we have pretty much a doji at the moment. A lot of uncertainty still. Okay, there's an uncertainty. They don't know whether the price would really go up or down at this point, but you're on level demand in an uptrend. Okay, cool. So it's part of the rules. Bullish bar buy, bearish bar sell. If you're currently sold and you're currently holding at this point in time, so you have a sell position. But if you had done nothing, then you don't have any trades at this point. Okay, now we have sellers currently in control. A continuation from there. So in other words, within the highs, see, notice about the highs, they are currently being rejected. We have a series of lower highs, part of that high, and there's some room in order to fill in around this point in time, right? There's that empty space. So what are you going to do? All right. Okay, we have the bulls are currently in control. Still, there's some more room in order for that to happen. You're going to buy, sell, or do nothing. Okay, let's move on. All right, there's an uncertainty. We have a higher high. We have a lower low. We now have a new set. From a higher high perspective, we have a lower low perspective. Part of that is lower low, higher low. So definitely this is the new pivoting point. However, that low broke through that low. We have a new high. So if there's a confirmation of a lower high, then that high is definitely a confirmation of a downtrend to continue to go further. Okay, here we go. Great. I can see that you guys are seeing things more clear. Awesome. So we have the pivoting point. Remember about the market giving clues, lower highs, more clear breakout. This is now the last low. This is no longer below because it didn't create a pivot. In actual fact, it broke out. We have a new lower low. You're going to sell, buy, or do nothing. Okay, next. Bingo. All right. We have a lower low. Buyers push the price the very last minute. So you're going to buy, sell, or do nothing, or at least basically close some of your positions if you're still sold from that here. and you're currently still on the hold, or you sold some, held, sold some, probably you'll be closing some positions, and then voila. All right, here we're going to continue. We have now a new lower high, lower low, but within the trend, remember it's still in an uptrend. We have a clear indication, higher low. Question is, as part of this segment, is this just a higher high, higher low, and then what do you think will be the next one of the series? Bulls are currently in control. Then by logical explanation, next one should be a higher high somewhere, sometime. Oh, did we create a new higher high, lower high? Okay, I think this is where we are. Oh, that's the time when it dropped. That's where we are at, right at this point. Great. So, Alicia, I think I find that you guys got it in terms of using that simple trading strategy, implementing what you see, because from what I can see, part of your answers, you're just simply now, you can see the pattern. Okay, well, sales are in control. I believe there's a little bit more in order for that empty space to happen. I see some saying holding or either selling, and then here buy, hold. Probably made some, maybe lost some, right? So at least you can see within part of that pattern, right? All right, shall I go through one more? Shall we do one more exercise before we wrap it up, or you guys are pretty much, you got the idea of part of a simple stuff? One more. All right, give me, okay, I will put in a stock price. Let me put in everyone's favorite friend. Where'd it go? Real time. I'll put Apple for now, okay? Just a form, an exercise right there. Okay, I put something in random. Notice how Apple has a lot of gaps. Apple is great for gap trading. If you know how to trade gaps, then they're pretty good. But nevertheless, okay, here we go. We have a bullish bar. We are currently in an uptrend from this point, from a higher high, right? Higher low. I apologize, by the way. I have my son crying on the background, if you can hear him crying. Okay, so we have the bulls are currently in control at this point. Are you going to buy, sell, or do nothing? Alrighty. So there's a nice big gap, but however, the bulls are currently in control. We have a series of higher highs and a series of higher lows. And how do we know? That's your pivot. That is your pretty much pivot. Nothing at the moment dictating, okay? Okay, the next price on where they need to beat is simply around this range between 451 454. Same rules apply. If currently bulls are in control, if the bullish bar, you buy, bearish bar, you sell. If it's a doji, either you do nothing, you can also buy or sell. Okay, here we go. Right, we have a higher high, higher low. The bulls are currently in control at this point in time, reaching the last, pretty much this area of supply at the moment, between 451 and 454. Right, everyone says buy. Bingo. Alrighty. If you did, congratulations, you made some money. Went all the way to breaking out within that high. So, in other words, we have a new higher high. Next price to beat is this, somewhere sometime in the long run, 465.44. Also between, take that within that range, between 461 and 465. Righty. Let's move on. Interesting. So that's how pretty much, because in the level of supply trying to stabilize itself, they need some form of a bit of a boost in order for the price to go to 460, 465. All right. We have a hanging man at the moment, meaning still just a type of a spinning top, still part of the uncertainty. And we have a, notice here, we have a pivot point, we have a higher high and a lower high. Don't know whether they should go push it further or basically not. Awesome. If you closed and took some money, congratulations. Okay, now there's more of a boost. Part of that, the bulls are currently in control, reaching at 465.44. And that's fine, right? It's okay. If you closed early, it's actually better to take some money rather than having regret. Better to make money than lose money, right? Okay. Bam. So from that point, bulls are currently in control. Still the bulls are in control. You're going to buy, sell, or do nothing. So if we just stick to the rules, the bulls are still currently in control, then we got to buy, right? Okay, then we have a higher high, lower low. We have a doji, stabilization, or what we call a harami in terms of the body. They don't know whether they can continue to go further or not. So from this, we need what would be the probability that if it's in the level of supply that it can correct itself. Okay, we'll see. So part of the neutral based is still neutral, doing nothing. Okay, you're going to buy, sell, or do nothing. Buy, sell, or do nothing, so it's correcting itself. Back to your level of demand. Sellers now are currently in control. Part of the demand level. Now we have the bulls back. So correction is over. Bingo. Higher high, higher low, new higher high. Holy moly, so that's where we are at today. So what do you think is the probability is going to go tomorrow? Bam. Yes, sir. Okay. Yeah, the probability, if the bulls are currently in control, the probability, look at the size of now the bars. Way too much. There's also the gap, but they fill the gap somewhere to create that low. So to go beyond that is actually highly probable. Now if we're going to go through on a bigger time frame with the weekly, easy. To go to 500, it breaks through 500, and the next one to go 540 is actually very, very easy. In actual fact, you have a clear confirmation for those pattern traders, or a clear confirmation of a double bottom. So from 400 to 460, from 460, 520. That is your major target point, which is a good supply level from here. Okay, so that's my take on it. Is 5. Sorry, excuse me. My take on it is 520 in the next few months, a few weeks. All right, cool. So now I hope you got something out of that. In terms of let's conclude it then. In terms of what the rules are, very, very simple. Once again, if it's very bullish, you buy. Bearish, you sell. Spinning top, either hold or do nothing. But obviously, if it's in a level of demand, even better, then you have to buy on an uptrending market. If it is on a supply and on a downtrending market, you just gotta sell, right? And to know specifically your higher highs, higher lows, your pivot points, probability of you winning is actually really, really, really high. Okay, so that's part of the exercise. I'm giving out $15,000. Basically, you're gonna start by September 7th. I'm choosing 10 lucky traders that will be personally coached by me for 30 days, teaching some of the trading methods and receive the trade alerts for 30 days. You attend the daily live classes. So my criteria is simply a person who's committed, hardworking, they're disciplined, will do anything to succeed, and I would need from that person an hour a day with no fail, in other words. So that if it's time for the person to give me homework, then they need to give me that homework, and obviously not everyone will be able to get in because part of the criteria I need to screen as well the potential student. Alrighty. Lastly, if you believe this, you email me. Coupon code actually the Inspire. There's a non-refundable commitment fee of $99 as part of the commitment, because if you don't have the $99, then why would you trade, right? You shouldn't be trading. Also, it's just simply just a commitment. It's a later on. My goal is to be committed that the trader will be consistently profitable in the next 3 to 6 months, right? And if they're not profitable or haven't made a single money for 3 months, a minimum of 3 months, then my job is to let them be profitable until they're profitable. So that will start on September the 7th. It's actually, I did record it today, so if you want a copy, actually, since you guys registered, I'll just do a, what do you call it, just a mail out, just simple, just one email to everybody who got in today. So if do you have any questions for me? I hope that you enjoyed that. Very, very simple. Practice, check it out, back test it yourself, and let me know. All right, can you please brief the program one more time, please? Yeah, so mainly the time component. There's going to be a day-to-day class simply from 6 to 7 Pacific Standard Time to compensate as well for some traders or some of the students that I'll be accepting part of the East Coast. And if they live in Australia or any part of the world, it's still pretty much a good time zone, right? But I just basically need from that person is a 1 hour commitment with that person, and they need to be, in other words, make it simply put, no excuses, because in my point of view, trading is not for everybody. It's simply for the elite, and it takes time and it takes some hard work in order to do it. So as part of that, I will give out, the electronic copy of my book so that at least they can read that first. And we part of the coaching is simply the psychology as well. I need to profile them, and not just the profiling, right? But the profiling is simply just to dictate whether if that person will be a day trader, a swing trader, a precision trader, and so forth. And then with the classes, well, if the person is stock traded, well, the methodology that they'll be learning can also be put into the stocks. But the classes will be based on the currencies. So if the person would like to trade with the currencies or will learn with the currency, then it'd be better for them. So correct, it is for 30 days. Basically be coaching for 30 days. Then after the 30 days, simply put, they really should have grasped the simple concept of what I will be teaching, and there's going to be a certain process. I'll be monitoring them after 30 days. Now, if they're not making any money, then I'll be helping them out until they make money, in other words, right? So after 30 days, now if they choose to go beyond the 30 days, then it's a small, basically $99 a month fee for simply just to come in, just to attend the classes and so forth, and part of the coaching and whatnot. But simply my goal is just to help out 10 traders. There are no strings attached. I mean, they do cost, they cost $3,000 just for a weekend workshop, but if they're members, they're $1,500 for the workshop. So it's mainly simply part of my gift. It's I call it, it's Reynaldo's August month because it's my birthday, and it's part of my gift to some lucky 10 traders, in other words, right? So yeah, that's pretty much it. And then if they want to go beyond that, and of course, I'm open to advance more trading strategies. Alrighty, if there's not any questions, I hope you guys enjoyed it. Thanks for coming in, and happy trading. Go out there, keep training, and keep making money. Alright guys, you have a good one and see you later. Bye now.